So right now, armed conflict in the Red Sea is basically forcing global shipping to entirely reroute its supply chains. I mean, it's wild.
Yeah, it really is. And oil prices are incredibly volatile, which, threatens to spike operational costs across the board.
Right. Plus, you've got geopolitical tension in the Middle East and across the Pacific at this, rolling boil.
Exactly. So by all traditional economic logic, a global maritime transport company should be bleeding cash right now.
Oh, absolutely. They should be bracing for impact, hoarding every single penny and basically begging their lenders for mercy.
Right. But instead, we are looking at Starbolt Carriers.
Yeah, one of the largest shipping companies on Earth.
And they are making so much money that their management team just stood in front of their investors and promised to give 100% of their free cash flow away.
Like every single extra dollar. It's crazy.
It's the ultimate paradox of the maritime shipping industry, really.
So welcome to another Talk Tickers Deep Dive. I'm glad you're here with us. Our mission today is pretty clear. We are breaking down the Q1 2026 earnings call for Starbolt Carriers.
And for those of you taking notes, the ticker symbol is SBLK.
Yep, SBLK. We're going to cut through all the heavy maritime jargon, highlight this truly wild capital allocation strategy they've got, and give you a clear, opinionated take on how this company operates in a world that just feels increasingly unpredictable right now.
Right. And frankly, we want to figure out if this stock is a buy, a hold, or a sell.
Exactly. So to do that, we really have to understand the fundamental mechanics of what they actually do.
Yeah. So Starbolt operates a fleet of 136 dry bulk vessels. They are basically the circulatory system of the global industrial economy.
Right. And we should clarify, they don't move containers full of, flat screen TVs or sneakers, right?
No, not at all. They move the raw earth, iron ore, coal, bauxite, grains, fertilizers.
The fundamental building blocks that make civilization possible.
Exactly. They are hauling millions of tons of dirt and food across the oceans.
Okay, so the first thing we need to do is look at the hard data. Let's look at the first quarter of 2026 for Starbolt. Break down the headline numbers for me, because, this is where the story actually starts.
Well, the raw financial performance for Q1 sets a very bullish tone right out of the gate.
Okay.
They reported an adjusted earnings per share, or EPS, of 52 cents.
Nice.
Yeah. And the total revenue for the quarter came in at $212.5 million.
Wow.
And their adjusted net income reached $63 million.
Okay, let's slow down and unpack that a bit. $212.5 million in revenue for a single 3-month period.
It's huge.
That is a massive volume of cash flowing through the business. But, revenue is just the top line, right? It's just the money coming in the door before you pay the bills.
Right, exactly.
So what is the actual profitability looking like before we factor in all the complex maritime accounting stuff?
For that, we really look at their adjusted EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. Their adjusted EBITDA for the quarter was $114.3 million.
Okay, so out of the $212 million in revenue, they kept roughly $114 million in pure operating earnings.
Yeah, that's better than a 50% margin.
That's insane. But explain to the listener why EBITDA is the specific metric we care about here. Why do we strip out interest, taxes, and specifically depreciation when evaluating a shipping company?
It's vital because of the capital-intensive nature of the industry. A modern dry bulk carrier is this floating steel fortress that costs tens of millions of dollars to build.
Right.
And under standard accounting rules, the value of that ship depreciates every single year it sits on the water.
Because it's slowly rusting and getting older.
Exactly. And that depreciation shows up as a massive expense on the income statement, which artificially lowers the net income number.
So on paper, the company looks like it's making less money because the accountants are basically forcing them to deduct the gradual aging of the ships.
Precisely. But depreciation is a non-cash expense. The company isn't actually writing a check for that aging process every quarter.
Oh, right. Okay.
So by looking at EBITDA, we strip away that accounting noise. It gives us a much clearer picture of the actual raw cash being generated by the physical operations of the fleet.
Okay, that makes total sense.
Yeah.
And $114.3 million in a single quarter proves that this fleet is basically a cash printing machine.
It really is.
But here is where it gets really interesting to me and where I want to push back a bit. Generating cash is great, but historically, cyclical companies are notorious for making a ton of money during the good times, but drowning in debt at the exact same time.
Oh, absolutely. The classic shipping trap.
Right. They spend all that incredible operating cash flow just keeping the commercial banks happy. So what does Starbolt's actual balance sheet look like? Because a cash printing machine doesn't matter if it's mortgaged to the hilt.
Well, their balance sheet is arguably their single biggest strategic advantage in this market. They ended the first quarter of 2026 with approximately $432 million in total cash and cash equivalents.
$432 million, just sitting there.
Highly liquid.
Highly liquid.
Yeah, and on top of that mountain of cash, they have an undrawn revolver capacity of $110 million.
An undrawn revolver. Okay, let me translate that for the listeners who might not live in the corporate finance world. That is basically a massive corporate credit card with a $110 million limit that management hasn't even touched yet.
That is a perfect way to conceptualize it.
It's a revolving line of credit. They don't pay interest on the bulk of it unless they pull the funds, but it is purely there, guaranteed by the banks for emergencies or like rapid acquisitions.
Exactly. It represents massive institutional trust. I mean, banks do not extend $110 million revolvers to companies they think are on the brink of insolvency.
Definitely not.
Now, against all that liquidity, we have to be objective and look at the liabilities. Their total outstanding debt is approximately $874 million.
Okay, stop right there. $874 million in debt.
I know, it sounds like a lot.
To an everyday investor, hearing that a company is carrying nearly $1 billion in debt sounds terrifying. In a high interest rate environment, that kind of debt load usually crushes profit margins. How can you look at nearly $1 billion in liabilities and call this balance sheet a fortress?
Because context is everything in asset-heavy industries. You cannot look at the debt in a vacuum. You have to look at the assets securing that debt.
Okay.
Let's look at their unencumbered assets. Out of their total fleet of 136 vessels, Starbolt currently owns 29 ships that are completely 100% debt-free.
Wait, 29 massive dry bulk carriers just floating out there on the oceans, hauling cargo and generating daily revenue, and they don't owe the banks a single dime on them.
Not a single cent. There is no mortgage attached to them whatsoever.
Wow.
And the aggregate market value of just those 29 debt-free vessels is around $700 million.
That's incredible. It's like owning a massive fleet of long-haul delivery trucks, where a huge chunk of them are completely paid off.
Yeah, exactly.
The monthly mortgage on the overall business is tiny relative to the massive physical assets you hold. The daily revenue from hauling cargo comes in, and management gets to just sit there and collect the extra cash without a banker breathing down their neck.
That analogy perfectly illustrates the operating leverage they've built. And, to add even more context to that $874 million debt number, management pointed out a critical historical trend during the call.
What was that?
Well, since 2021, they have aggressively deleveraged the company. They've reduced their total net debt by a staggering 63%.
A 63% reduction in net debt in just a few years.
Yeah.
So they took the massive profits from the post-pandemic supply chain boom, and instead of squandering it, they paid off the mortgage. That is a really disciplined management team.
It is incredibly disciplined. And this deleveraging brings their risk profile down to a fascinating metric that is pretty unique to the maritime world. Their total net debt is now sitting at just 56% of the demolition value of their fleet.
Demolition value. I absolutely love this concept, but it sounds incredibly bleak. Explain what demolition value actually means and how the global shipbreaking market works.
Right. So demolition value, or scrap value, is literally what the entire fleet would be worth if management decided tomorrow to sail every single ship onto a beach, cut them all up with blowtorches, and sell the raw steel by the ton.
Wait, they literally just drive the ships onto a beach?
Yes. The global ship recycling industry is largely centered in places like Alang, India, or Chittagong, Bangladesh.
Okay.
And at high tide, a captain will literally run the ship aground onto the mudflats.
That's wild.
Then, massive crews of workers descend on the vessel and dismantle it piece by piece. The engines, the electronics, and most importantly, the tens of thousands of tons of heavy maritime steel are cut apart and sold to local re-rolling mills.
To be melted down and turned into rebar for construction, right?
Exactly.
So it's the absolute rock bottom, worst case scenario liquidation value of the physical asset, assuming the ship can never carry a single piece of cargo ever again.
Precisely. The value is calculated based on the light displacement tonnage, or LDT, of the vessel, multiplied by the current global price of scrap steel. It acts as a hard synthetic floor for the value of the company's assets.
So let me get the math straight on this. Their total net jet is only slightly more than half of what they could get if they literally just scrapped every single ship they owned today.
Oh, yes, exactly.
Wow.
It means their financial risk is incredibly low. As their chief financial officer, Christos Pageras, stated on the call, this low overall leverage and this unencumbered asset base provides substantial financial flexibility to fund growth opportunities.
Right.
But more importantly for the retail investor, it provides massive downside protection.
Let's talk about that downside protection. Because if the global economy completely freezes, say a massive recession hits, trade stops, and shipping charter rates plummet to zero, Star Bulk is in a position to easily survive a multi-year winter.
Absolutely.
Their debt service is low, their cash pile is high, and if things get truly apocalyptic, they can just sell a few of those 29 debt-free ships for pure cash.
Right. While highly leveraged competitors who bought ships at the top of the market using expensive debt might be forced into bankruptcy, Star Bulk can simply weather the storm. It's a textbook defensive posture.
Okay, so we see the massive pile of cash, and we understand the balance sheet is basically bulletproof. But to figure out if this cash generation is sustainable, we have to look under the hood at the actual daily operating margins.
Let's do it.
Because $212 million in quarterly revenue sounds great,
Yeah.
but how much does it actually cost to run these floating steel behemoths every single day? Let's get into the unit economics.
The unit economics, the daily operating metric, are really where the efficiency of Star Bulk's integrated platform shines. The single most important metric in shipping revenue is the time charter equivalent, or TCE.
Okay.
For the first quarter, their TCE was $18,493 per vessel per day.
Let's break that down for the listener. TCE, time charter equivalent. This is essentially the gross daily profit a single ship makes after paying for its own specific voyage costs, right?
Yeah, that's correct. When a ship takes a cargo contract, it incurs variable voyage costs, primarily the bunker fuel it burns to cross the ocean, and the port fees it pays to dock and load the cargo.
Makes sense.
TCE takes the total revenue from that contract, subtracts those specific voyage costs, and divides it by the number of days the voyage took.
Ah, okay.
It's a standardized industry metric that allows you to compare the revenue performance of different ships taking different routes on a level playing field.
So on average, after paying for fuel and port tolls, every single one of their ships is generating $18,493 in revenue every single day.
Yes.
And they have 136 ships.
Right.
So you multiply that 18.5 grand by 136 every single day of the week, including weekends and holidays. The cash generation is wild.
It really is.
But of course, the ship doesn't run itself. You have to pay the crew, buy the supplies, pay for maintenance. What are the fixed daily costs to keep the lights on?
That brings us to their daily OPEX, or operating expenses. Their combined daily OPEX and net cash general and administrative expenses, the corporate overhead, or G&A, came in at a combined $6,420 per vessel per day.
Okay, I want to split that up because the source material gets very granular here, and I think it's really important to understand how lean this operation is.
It is incredibly lean. The chief operating officer, Nikos Reskos, broke it down specifically. The pure daily OPEX for the vessel itself was $5,045.
Okay.
And the net cash G&A, which covers the office staff, the executives, the software systems, was $1,375 per vessel per day.
Wow.
Both of those figures are among the absolute lowest in their entire peer group.
Okay, I have to push back here, or at least express some disbelief. $5,045 a day to run a ship. To a retail investor, $5,000 sounds like a lot of money. But to run a 900-foot floating industrial facility, that sounds completely impossible.
Does sound pretty low?
I mean, if I rent a decent suite in a Manhattan hotel, that's maybe $1,000 a night, and that's just a bed and a shower. How are they operating a steel Leviathan crossing the Pacific for only 5 times that amount? What exactly does that $5,000 pay for?
It is a phenomenal feat of unit economics, really, and it highlights why scale matters in this industry. That $5,045 covers everything required to keep the vessel seaworthy and compliant.
Like what?
First, it covers crew wages. A standard dry bulk carrier usually operates with a crew of 20 to 24 highly trained seafarers. You are paying their salaries, their benefits, and their travel costs to and from the vessel.
So you're housing and paying 24 people. What else?
It covers all of their provisions, food, fresh water, basic living supplies for months at sea.
Right.
Then you have the mechanical consumables. The engine of a Capesize bulk carrier is the size of a 3-story house.
Wow.
Yeah. It requires a constant, massive stream of specialized lubricating oils and chemicals just to keep from tearing itself apart. The OPEX covers those lubricants. It covers routine maintenance, spare parts, paint, and safety equipment.
And insurance, right?
Right.
Because you can't put a $50 million asset on the ocean without insuring it.
Exactly. It covers incredibly complex maritime insurance premiums, specifically protection and indemnity, or P&I insurance, which covers third-party liabilities like environmental spills or cargo damage, as well as hull and machinery insurance to cover the physical ship itself. To manage all of that, wages, food, parts, oil, and insurance for just over $5,000 a day requires extreme operational discipline.
How do they get the costs that low? Are they cutting corners on safety?
No, not at all. They achieve it through massive economies of scale. Resco's attributed this sustained cost discipline directly to their integrated management platform and the synergies they crystallized through the recent major acquisition of Eagle Bulk.
Okay, so when you operate a fleet of 136 ships, you don't buy lubricating oil by the barrel. You buy it by the tanker load.
Exactly. You negotiate fleet-wide discounts with the P&I insurance clubs. You have immense purchasing power for spare parts.
It's basically the Costco model of maritime operations.
That's a great way to put it.
Buying in extreme bulk drives the unit cost down to the absolute floor. So let's do the back of the napkin math here. You take the daily revenue of $18,493. You subtract the total daily running cost of $6,420. That leaves you with
a daily cash margin of approximately $12,073 per vessel per day.
Over $12,000 in pure cash margin per ship every single day before they pay for debt service and capital expenditures.
It's a massive margin.
It really is. And management noted on the call that these are considered mid-cycle levels. This isn't even the absolute peak of a shipping boom, and they are still printing that kind of cash.
It translates directly into superior cash generation through the entire cycle of the market. Because their costs are so low, rates can drop significantly before they ever start losing money.
So they have this incredible, highly efficient cash engine. But here is where we have to connect the micro level of the company to the macro level of the global economy.
Right.
Because shipping does not exist in a vacuum. It is entirely dependent on what is happening in the wider world. And right now, the wider world is incredibly messy.
Very messy.
We need to look at the story behind these margins. We have global conflicts, we have changing weather patterns, we have trade wars. Let's start with the geopolitics. Tensions in the Red Sea and the Persian Gulf.
Yeah, that's a huge factor.
I look at armed conflict in major shipping lanes, and my first instinct is that war is terrible for business. The risk of ships getting attacked, supply chains freezing up. But from what I'm reading in this earnings call, this geopolitical chaos is actually helping them.
It is a deeply counterintuitive phenomenon. You would naturally assume conflict destroys value. But yes, currently, the chaos in the Middle East is providing a massive tailwind to their daily charter rates.
Wow.
To understand why, we have to look at the simple physical laws of supply and demand in the maritime market.
Walk me through the physics here. How does a crisis in the Red Sea make a Greek shipping company more money?
Well, when military tensions escalate in critical choke points like the Red Sea or the Persian Gulf, two things happen immediately. First, the maritime insurance premiums to sail through those designated war zones absolutely skyrocket. Suddenly, it costs a fortune just to legally enter the water.
Makes sense.
Second, the physical risk to the vessels and the human crew becomes unacceptable for many operators and charterers.
Right. Nobody wants a multi-million-dollar asset and 24 crew members put in the line of fire.
Yeah.
So what's the alternative?
The alternative is diversion. Instead of sailing from Asia to Europe through the Suez Canal, which is the fast, direct route they have to reroute their ships south, all the way around the Cape of Good Hope at the southern tip of Africa.
Which takes way, way longer.
It adds thousands of miles and weeks of transit time to a single voyage. And this is where we have to introduce a crucial industry concept. Ton miles.
Ton miles.
Okay. In the shipping industry, demand isn't just measured by how many tons of cargo need to be moved. It's measured in ton miles. 1 ton of cargo moved 1 physical mile.
Okay, so if I need to move 1 million tons of iron ore, the demand on the shipping industry is vastly different if I'm moving it from Australia to China versus moving it from Brazil to China.
Right.
The longer the distance, the more work the ships have to do.
Exactly. If a voyage suddenly takes twice as long to deliver the exact same amount of cargo because it has to sail around Africa, it essentially ties up that specific ship for a much longer period. The ship is unavailable to take another contract.
Ah, I see the mechanism now. Even though the actual amount of cargo in the world hasn't changed, the distance it has to travel has increased.
Precisely.
So it shrinks the available global supply of ships at any given moment because they're all stuck taking the long way around.
You got it. And what happens in any free market when supply shrinks dramatically while demand remains constant?
The price goes up. the daily freight rates skyrocket because charterers are fighting over a smaller pool of available ships.
Correct. But there is a second major factor driven by these geopolitical tensions: the price of oil. When conflict threatens the Middle East, global energy markets panic, and the price of bunker fuel, the thick, heavy fuel oil that these ships burn, goes up.
Wait, so their primary variable cost fuel goes up. How on earth is that a good thing for their bottom line?
Because of how the entire industry responds to expensive fuel. When bunker fuel becomes highly expensive, the most economically rational response for a ship operator is to practice a maneuver called slow steaming.
Slow steaming, meaning they literally just tell the captain to drive the ship slower.
Yes. They intentionally reduce the cruising speed of the vessel. And the reason they do this comes down to fluid dynamics. The relationship between a ship's speed and its fuel consumption is not linear, it is exponential. It follows the cube law.
Okay, give me an analogy here, because fluid dynamics usually puts people to sleep.
Okay, think about driving a car. If you're driving down the highway at 60 miles an hour, your car gets relatively good gas mileage. If you slam on the gas and push it to 90 miles an hour, your fuel efficiency absolutely craters.
Right.
You aren't just burning 50% more gas because you're going 50% faster.
Yeah.
You are burning gas exponentially faster because you are fighting a thicker wall of aerodynamic drag. Air resistance increases with the square of your speed.
Right. Fighting the wind at 90 miles an hour takes a massive amount of horsepower.
Exactly. Now apply that to a cargo ship. But instead of fighting air, a 900-foot steel wall is fighting water, which is nearly 800 times denser than air.
Oh, wow.
Yeah. If a captain wants to increase speed by just a couple of knots, the engine has to burn a geometrically larger amount of fuel to overcome that hydrodynamic drag.
Okay.
Conversely, if you reduce your speed by just a few knots, your fuel consumption drops dramatically, saving you tens of thousands of dollars a day.
So when fuel gets expensive, every smart operator decides to slow down to save cash.
Exactly. During the first quarter, the average speed of the global dry bulk fleet corrected downward to below 11 knots, specifically because of the surge in bunker prices amid the Middle East tensions.
Wait, so let me connect the dots here because this is a brilliant compounding effect. Fuel gets expensive, so every ship on Earth decides to drive slower to save money.
Right.
But if every ship is driving slower, then every single voyage takes even longer to complete, which means, once again, you are effectively shrinking the global supply of available ships.
You've got it. It is a dual supply constraint. They are taking longer routes around Africa, and they are driving slower while they do it.
That's fascinating.
As CEO Petros Pappas pointed out on the call, Starbulk has about 2% of the entire global fleet effectively tied up just dealing with the Persian Gulf and Red Sea diversions.
Wow.
All of this creates more ton miles, reduces the effective supply of vessels, and keeps those daily TCE rates incredibly high.
That is a masterclass in macroeconomic physics. But I have to challenge this narrative.
Okay, go for it.
Global conflict and tension are creating a short-term cash bonanza for Starbulk. But isn't that a dangerous double-edged sword? If fuel costs go too high because of a wider war, couldn't it eventually destroy the very trade it relies on?
That's a very fair point.
I mean, there has to be a breaking point where the cost of shipping becomes so astronomical that countries just stop buying the raw materials.
You are identifying the exact structural risk to this thesis, and to management's credit, they were very objective about acknowledging it during the Q&A session of the earnings call.
Oh, they did?
Yeah. An analyst named Stephanie Moore from Jefferies specifically pressed them on this exact point. She asked, if emerging markets are negatively impacted by persistently higher energy costs, will it cause economic weakness that crushes raw material demand?
And what was the CEO's response? Did he brush it off?
No, Petros Pappas confirmed the risk outright. He stated clearly that if oil prices go further up, say to $150 a barrel or more, they are very afraid that it would damage the world economy. It would fundamentally discourage trade.
Because trade only works if the math makes sense.
Exactly. Yeah. Global trade fundamentally depends on one country being able to produce something cheaper than another country can produce it domestically.
Right.
The shipping cost is the bridge between the buyer and the seller. If that bridge becomes too expensive to cross because bunker fuel costs $1,500 a ton, trade simply stops. Commodities become too expensive, inflation spikes, and industrial demand evaporates.
So Starbulk is operating in a very delicate sweet spot right now.
They are.
The geopolitical tensions are high enough to constrain ship supply and artificially boost charter rates, but they're not quite so high that $150 oil destroys the global economy.
It is a Goldilocks zone of volatility. But beyond these geopolitical supply constraints, we also have to look at the macro demand drivers.
Okay.
Because you can have all the supply constraints in the world, but if nobody wants to buy iron ore, the ships sit empty. And you cannot talk about dry bulk shipping demand without talking about the undisputed heavyweight champion of raw materials, China.
Right, because China is the factory of the world. They import the iron ore to make the steel for their cities. They import the coal to run the power plants to keep the factory lights on. They import the bauxite to make aluminum. They are the engine of the dry bulk market.
Absolutely.
So what did the data actually show about China in Q1? Because the news out of China lately has been full of real estate collapses and economic slowdowns.
The narrative of a collapsing China is a bit more nuanced when you look at the raw commodity data.
Okay.
According to Star Bulk's head of market research, Costadinos Matiras, China's overall GDP growth actually exceeded macroeconomic expectations, coming in at 5% in the first quarter.
That's solid.
And more importantly for shipping, against a relatively low base from last year, China's total dry bulk imports rose a staggering 8.1%.
8.1% growth in physical imports. That is a massive volume increase for a single quarter in an economy of that size.
It is massive. However, Matiras was careful to provide the full picture. He noted that Chinese domestic consumption remained relatively weak, and crucially, their domestic steel production actually declined by 4.5% year over year.
Wait, that doesn't make sense. If their steel production is down by almost 5%, why are their bulk imports, which are mostly iron ore used to make steel, up by 8%? Where's the rock going?
It's going into storage. The decline in steel production was due to government policy curves on supply, the ongoing and severe real estate slowdown, and rising global protectionism against cheap Chinese steel exports.
Right.
But because domestic iron ore production within China remained flat and prices were favorable, they continued to import heavily. Their port stockpiles of iron ore increased to near record levels. They are buying it and hoarding it.
So they are acting opportunistically. But that creates a massive risk, right? Matiras must have warned about this. If they're just building stockpiles, eventually the yards get full. And when they stop buying to work through that inventory, demand for ships is going to fall off a cliff.
He explicitly warned that this creates a downside risk for the second half of the year if the stockpiling ceases. But for now, the iron ore market remains supply-driven. And again, ton miles save the day.
How so?
New long-distance iron ore exports are ramping up from places like the Simandu mining project in Guinea, Africa, and from traditional heavyweights in Brazil. A ton of iron ore from Brazil to China requires vastly more ship time than a ton from Australia to China.
Okay, so iron ore is a mixed bag, a bit precarious because of the stockpiling, but mostly positive right now because of the ton-mile expansion from the Atlantic Basin.
That's a great summary.
What about the other commodities? Because there was a completely wild statistic in the research notes about weather patterns, El Nino. How does a cyclical weather pattern in the Pacific Ocean impact the quarterly earnings of a Greek shipping company? It sounds like the butterfly effect.
It is the ultimate manifestation of the butterfly effect in global supply chains. It's a fascinating multi-step chain of events. A developing El Nino weather pattern alters global atmospheric circulation. This year, it is expected to drive a significantly hotter summer in the Northern Hemisphere, particularly in specific industrial regions of China.
Okay, hotter weather means more people and businesses turning on their air conditioning.
Exactly. A massive spike in air conditioning use means a massive, sudden, higher demand for electricity generation.
Right.
Now, normally, China relies on a mix of power sources, including a massive hydroelectric dam network. But El Nino often brings localized droughts to those hydro-producing regions. If the rivers run low, the dams can't produce enough power to meet the air conditioning spike.
So if the dams fail to meet the load, what do they turn to?
They turn to thermal power, specifically coal-fired power plants. In Q1, their thermal power generation already rose by 3.6% to meet early demand. But here's the kicker. Their domestic coal mining production remained totally flat.
So they need more power to run the AC, the dams are dry, and they aren't mining enough coal at home to feed the furnaces. They have to import it from overseas.
Exactly. They have to buy coal from Indonesia, Australia, or even further afield, which means they need more bulk carriers to move it. A weather phenomenon over the ocean literally dictates the demand for millions of tons of bulk coal shipments.
That highlights just how intricately interconnected global systems really are. You can't just look at a spreadsheet, you have to look at the sky.
Well said.
And it's not just coal, right? The source material also highlighted shifting dynamics in the agricultural trades.
Yes, the grain trades are another massive component of dry bulk demand. Total global grain exports increased by 9.1% year over year in the first quarter.
9.1% growth in grain shipments. What is driving that surge?
A combination of strong harvest shipments from major exporters and macroeconomic diplomacy. The company's research presentation explicitly pointed to recent diplomatic events. They noted that the summit between former President Trump and President Xi in Beijing delivered a highly constructive signal for U.S.-China relations regarding international trade.
Interesting.
Following an October trade truce, Beijing officially pledged to buy approximately 25 million tons of U.S. soybeans annually through the year 2028.
And as an objective data point, we don't care about the politics of the summit. We care about the physics of the trade.
Right.
25 million tons of soybeans traveling from the agricultural ports in the U.S. Gulf Coast all the way across the world to China is an incredibly long route. It is a massive ton-mile generator for these mid-sized bulk vessels.
Exactly. It ties up a huge portion of the agricultural shipping fleet for weeks at a time.
So if we synthesize all of this, we have a myriad of disparate, seemingly unconnected global factors. War in the Middle East forcing ships around Africa. A hotter summer in Asia, driven by El Nino forcing coal imports. A diplomatic trade truce in Beijing forcing soybean exports. All of these factors are conspiring simultaneously to keep the demand for raw material transport high, while structurally shrinking the available supply of ships to carry it.
Which perfectly explains the underlying mechanics of that massive $12,073 daily cash margin per vessel we analyzed earlier.
Okay, the picture's coming into focus. We've established that Star Bulk is printing cash. We know they have a fortress balance sheet with massive downside protection in the scrap value of their fleet.
Right.
We know the macro environment, despite real risks like $150 oil, is highly favorable to them right now. This leads us to the single most important question for any retail investor listening to this. What is management actually doing with all that cash?
That is the million-dollar question.
How are they planning to allocate it? Because a company can make $1 billion, but if management sets it on fire, the shareholder gets nothing.
This brings us to their capital allocation strategy. And this is precisely where Star Bulk differentiates itself from decades of historically poor management across the broader shipping sector. Let's start with the dividend.
Okay.
The board of directors declared a 50-cent per share dividend for the first quarter.
50 cents a share. Depending on the stock price, that represents a very healthy annualized yield. But the raw number isn't as interesting as the corporate policy behind it, right? What is their updated framework for distributing cash?
To further enhance shareholder value, management updated their official policy. They are now committed to distributing exactly 100% of their free cash flow directly to shareholders.
Okay, I have to stop you again because I need to violently attack this premise.
Yeah.
Distributing 100% of free cash flow, giving every single extra dollar back to the investors.
I know, it sounds extreme.
That sounds completely reckless. When I look at corporate history, the companies that survive centuries, the Apples, the Microsofts, the Berkshire Hathaways, they hoard cash. They build a war chest for a rainy day.
Right.
If you distribute every single dollar of free cash flow, you have zero safety net. You are walking a tightrope without a harness. What happens if China's property market fully collapses tomorrow, demand for iron ore goes to zero, and daily charter rates plummet to $2,000 a day? Aren't they just artificially juicing the stock yield at the expense of the company's long-term survival?
That is the exact pushback a prudent investor should have. But you have to look at the fine print of the policy, and you have to remember the balance sheet we discussed earlier.
Okay, I'm listening.
It is 100% of free cash flow, subject to maintaining a minimum cash balance of $2.1 million per vessel.
Ah, okay, so they keep a slush fund of a couple million per ship.
Yes. Across 136 ships, that minimum cash balance ensures they always have nearly $300 million in pure liquidity on hand to cover operations, unexpected maintenance, or a sudden drop in charter rates.
That makes a difference.
They are not emptying the bank account to zero. And furthermore, remember those 29 completely debt-free ships?
Right, the $700 million in unencumbered assets.
Exactly. If the apocalypse scenario you described actually happens, they have massive untapped borrowing capacity. They could walk into any maritime bank in the world, pledge a few of those debt-free ships as collateral, and walk out with a fresh $50 million credit line in an afternoon.
Oh, wow.
Their survival is not in question, which gives them the luxury of returning all excess cash to the owners of the business.
Okay, that makes sense. The safety net is baked into the assets, not just the cash flow. But still, usually, corporate management teams love to keep cash so they can build an empire.
Oh, yeah.
They want to buy a rival company, build a shiny new headquarters, or order a dozen brand new ships just so the CEO can brag at a conference that he has the biggest fleet on the water.
You are describing the classic shipping industry trap known as empire building, and it is the primary reason shipping stocks have historically been terrible long-term investments.
Really?
Oh, absolutely. Historically, when shipping rates went up and cash poured in, owners suffered from extreme hubris. They would take all their profits and immediately run to the shipyards in China or South Korea to order a massive slew of brand new vessels.
Because they assume the good times will last forever.
Precisely. But shipyards take 2 to 3 years to build a ship, so what happens?
I'm guessing the market cools off.
2 years later, the economic cycle has naturally cooled down, demand has softened, and suddenly hundreds of brand new ships hit the water at the exact same time. It violently floods the market with excess supply, crushes the daily charter rates, and bankrupts half the industry. It's a self-inflicted boom and bust cycle.
Wow. So Starbulk is explicitly refusing to play that game. They're looking at the cash, looking at the temptation to build an empire, and saying, no, we're just going to hand the money back to the people who own the stock.
Exactly. And the massive dividend isn't the only way they're returning capital.
What else are they doing?
During the first quarter, and up until the date of the earnings call, they actively repurchased approximately 1.9 million of their own shares in the open market, spending roughly $37.9 million to do it.
Share buybacks. So they are taking the cash and buying out their own partners. By actively shrinking the total number of slices in the corporate pie, they make every remaining slice, every remaining share held by a retail investor intrinsically more valuable.
Yes, exactly.
And it means each remaining share is entitled to a larger chunk of that 100% free cash flow dividend in all future quarters.
It is an incredibly disciplined, compounding approach to value creation. Over the last 6 years, as summarized by the CFO, their strict capital allocation track record has resulted in returning approximately $2.71 per share in direct dividends.
That's a lot.
When you add it all up, they have returned about $1 billion in gross value to their shareholders.
$1 billion returned. As we discussed in the intro, management is acting less like swashbuckling ship captains wanting to conquer the seas, and much more like disciplined, cold-blooded value investors.
That is a very accurate assessment.
But your earlier point about survival raises another critical question. If they're giving all their free cash flow away to investors, how are they maintaining the physical fleet?
Right, that's important.
Ships do not last forever. They sit in corrosive salt water 24 hours a day. They rust, their engines wear out, their designs become hydrodynamically obsolete. If you don't reinvest in the physical assets of the business eventually sinks. Literally.
You're right.
If they aren't empire building, what is their actual fleet strategy going forward?
They are managing a very careful balancing act of fleet rejuvenation. On the new building front, they do currently have 8 of the latest generation, high-specification, customized ships on order.
Wait, I thought we just said they weren't ordering new ships. 8 new ships sounds like a lot of capital expenditure.
The timing is the crucial detail here. These orders were placed previously during a dip in the market when shipyard prices were favorable. All 8 are on track for delivery during 2026. The remaining capital expenditure required to pay the shipyards for them is $195 million. But here is the key to their discipline. The financing for these new builds is already entirely locked in.
How so?
They secured $130 million in debt financing against 5 of the vessels being built in Qingdao, and they expect to secure another $51.2 million against 3 vessels being built at the Hengli shipyard. The entire program is fully funded on highly competitive terms.
Okay, so they aren't using today's massive daily operating cash flow to pay for these new ships. The debt structure was mapped out years ago.
Exactly.
And because they ordered these ships a while ago when steel and labor prices were lower, the prompt delivery of these vessels right now is actually a huge win. The COO, Nikos Reskos, noted that the current market value of these ships is far higher than what they contracted to pay for them, representing an approximate $40 million mark-to-market gain for the shareholders the second they touch the water.
Exactly. They bought low. But your question about ordering ships today is highly relevant. An analyst on the call specifically asked CEO Petros Pappas about their appetite for ordering even more new vessels right now, given how strong the market dynamics and charter rates are.
And what did the CEO say? Because if the market is this hot, the temptation to call the shipyard must be overwhelming.
Pappas was incredibly blunt. He said new building prices at the shipyards have gone up astronomically. They ran the internal financial models, and he stated that you would need to guarantee extremely high daily charter income levels for very long periods of time just to achieve relatively low single-digit internal rates of return on a new ship purchased at today's inflated prices.
The math simply doesn't work. To pay off an $80 million new ship, you'd need the Red Sea crisis to last for 15 years, which is an absurd bet to make.
Precisely. He explicitly stated that their strategy is not to continue any further with new buildings. He noted that historically, ship asset prices run in distinct cycles, and Star Bulk is perfectly willing to be patient. For as long as asset prices keep climbing, they see it as a much better opportunity to sell their older, less efficient assets into a hot market rather than buy or order new ones at the peak.
Selling their older assets, that's the other side of the rejuvenation equation. If they aren't buying, what are they selling?
During Q1, they delivered 2 older vessels, the Star Scarlet and the Star Mariella, to new owners, collecting net proceeds of approximately $46.4 million.
Not bad.
And stepping back to look at the broader trend, since 2023, they have opportunistically sold off 39 older vessels. They then reinvested the majority of those proceeds to fund those highly accretive share buybacks we talked about.
Selling aging steel assets at the absolute top of the market cycle and using the cash to buy back their own undervalued stock. It is textbook, disciplined capital rotation.
It is. But for the core 136 ships they are keeping, they aren't just letting them degrade into obsolescence. They are pouring strategic capital into high-tech upgrades to make them vastly more efficient.
Let's talk about that technology, because the upgrades they discussed on the call are fascinating.
They really are.
To an outsider, a cargo ship looks like dumb 19th century technology.
Yeah.
Just a big metal bucket with a diesel engine. But this isn't just slapping a new coat of paint on a boat.
Well, actually, a highly engineered coat of paint is a major part of their strategy.
Oh, really?
Yeah, it's advanced, low-friction silicone paint. They are heavily focused on deploying what the industry calls energy-saving devices, or ESDs. To date, they have completed 61 discrete ESD installations across the fleet, with 8 more scheduled for 2026.
Break down what an energy-saving device actually is. Are we talking about solar panels?
No, it's mostly advanced fluid dynamics. It includes high-efficiency propeller retrofits that reduce cavitation and wasted energy in the water. It includes advanced telemetry systems that monitor engine performance in real time. And most interestingly, it includes the deployment of automated hull cleaning robots.
Hull cleaning robots. Like underwater Roombas for massive cargo ships. That is amazing. Why is that necessary?
Because of marine biofouling. When a ship sits in the water, algae, barnacles, and marine life attach to the steel hull. Over time, this creates a rough surface.
Okay.
In water, which, as we discussed, is incredibly dense, this microdrag multiplies exponentially. It forces the engine to burn significantly more fuel just to maintain the same speed.
Wow, I never thought about that.
Historically, ships had to go into dry dock to be scraped clean. Now, Star Bulk uses these underwater robots to continuously strip the biofouling off while the ship is waiting at anchor, constantly restoring its hydrodynamic profile.
That is brilliant. But what is the actual financial impact of all this tech? Does silicone paint and an underwater Roomba actually move the needle on a multi-billion-dollar balance sheet?
It moves it significantly. Resco stated that together, these upgrades result in a measured, tangible vessel performance improvement of between 7 and 15%.
A 15% efficiency gain on a fuel bill that runs into the hundreds of thousands of dollars per voyage is massive.
Yeah.
It drops straight to the bottom line.
It translates directly into less fuel burned, lower daily OPEX, and crucially, improved commercial attractiveness. When a charterer is looking to hire a ship, they prefer the one with a 15% lower fuel consumption because the charterer often pays for the fuel.
Oh, that makes sense. So they have this incredibly tight operation, a disciplined management team refusing to overpay for ships, and a highly profitable macro environment. But we also have to look at the broader regulatory horizon.
Right.
Because global shipping burns fossil fuels, and they are under immense existential pressure from governments to decarbonize. What did their chief strategy officer, Teres Plekantunaki, have to say about the environmental regulations?
The regulatory landscape is currently in a state of chaotic flux, and it's heavily impacting industry supply.
How so?
She highlighted the latest session of the IMO, the International Maritime Organization's Marine Environment Protection Committee. Interestingly, no consensus was reached on the net zero framework.
Really?
Yeah. Member states are deeply divided between those who think the current emission rules are fit for purpose and those calling for aggressive amendments and carbon taxes.
So the global rules on carbon emissions for shipping are basically stalled out right now. The governing body can't agree on what the future fuel of the industry should be.
Stalled, but actively and fiercely debated. They agreed to continue intersessional work to try and achieve some sort of consensus by late 2026. But this regulatory paralysis is actually creating a massive barrier to entry. If you are a rival ship owner, do you order a $50 million ship today that burns heavy fuel oil, knowing the IMO might outlaw it or tax it into oblivion in 10 years?
Or do you order a ship that burns green methanol, even though there is no global infrastructure to refuel it?
Exactly.
You risk buying a $50 million stranded asset. So the smartest move is to do exactly what Star Bulk is doing. Absolutely nothing. You don't build anything until the regulators make up their minds.
Exactly. But Star Bulk isn't just passively waiting around. Plakon Tunaki noted they joined the newly established advisory council to the Poseidon Principles Association.
What's that?
This is a dialogue forum between 36 major signatory banks and maritime stakeholders to figure out how to actually finance the green transition once the rules are set.
So they are sitting at the table trying to help write the rules, rather than just waiting to be regulated out of existence.
Yeah.
I also noticed in her section, she mentioned they are heavily investing in artificial intelligence. It seems like a buzzword. What is a bulk commodity shipping company doing with AI?
They are embedding it deeply into their daily operations to find micro efficiencies. They have expanded a custom-built company, Transport AI, adopted off-the-shelf tools, and are running advanced external risk assessments and penetration tests to ensure the cybersecurity of these AI deployments.
What does the AI actually do, though?
It analyzes decades of historical weather data, ocean current models, and port congestion statistics to optimize route planning.
Oh, that's smart.
Yeah, if an AI can route a ship around a storm system more efficiently than a human captain, saving half a day of steaming time and 10 tons of fuel, those savings compound across 136 ships over 365 days. It's about wringing every last drop of margin out of the operation.
Okay, so we've covered the micro-level operations extensively. The unit economics, the 12K daily cash flow, the underwater robots, the AI routing, the disciplined refusal to build an empire.
It's a lot.
It is. Let's pull it all together into the big picture. What does this mountain of data actually mean for a retail investor trying to evaluate this company or the broader shipping sector?
The bottom line, synthesized from all this data, presents a very clear, structurally bullish stance on Star Bulk's immediate future. And it comes down to two very specific structural factors in the global market that management highlighted.
Let's hear them.
First and foremost, the global order book.
Let's define the order book. This is the official list of all the brand new ships currently contracted to be built in shipyards around the world. What does the global dry bulk order book look like right now?
According to Costadinos Matiris, the new building order book has increased slightly over the past 3 years from absolute rock bottom levels, but it remains historically very low. Currently, it stands at just 13.2% of the existing global fleet.
13.2%. Why is that specific number considered a bullish indicator?
Because in past historical boom cycles, like the massive 2008 shipping supercycle, that number would balloon to 30, 40, or even 50% as greedy owners ordered massive fleets. Wow.
When an order book is at 40%, it guarantees that a tidal wave of new vessel supply is going to hit the water and crush daily charter rates. A 13.2% order book means that over the next 3 to 4 years, the supply of new ships hitting the water is going to be severely constrained.
There is a massive structural barrier to entry right now. As we discussed, shipyard prices are simply too high for the math to work, and the yards themselves have limited building capacity available until late 2028 because they're busy building expensive LNG carriers. Plus, owners are terrified of the IMO regulations and stranded asset risk.
Exactly. Supply is artificially capped by high prices and regulatory fear. We are not going to see a flood of new ships ruining the charter rates anytime soon.
Okay, so new supply is constrained, but what about the existing ships that are already on the water?
That is the second major structural factor driving the bull thesis. The global dry bulk fleet is aging rapidly. By the end of 2027, management estimates that approximately 50% of the entire existing global dry bulk fleet will be over 15 years old. 50%. Half the ships carrying the world's raw materials are basically getting ready to collect Social Security.
Exactly. And in the maritime world, age equals inefficiency. Older ships burn more fuel, they break down more often, and they cannot compete with modern eco vessels.
Right.
More importantly, as they age, they are much more likely to be sent to the scrapyard for demolition, permanently removing them from the supply pool.
Back to the beaches in India.
Precisely. Furthermore, as ships cross the 15-year mark, maritime law requires them to undergo rigorous, highly expensive, mandated special surveys in dry dock to ensure they are still structurally seaworthy.
Meaning they have to be pulled out of the water and heavily inspected.
Yes. Mateers estimated that the rising number of aging vessels forced to undergo their third special survey will temporarily remove a massive amount of tonnage from active commercial service. He projects this dynamic will effectively reduce overall fleet capacity by more than 0.5% per year during 2026 and 2027.
So, to summarize the supply side of the global equation, shipyards aren't building enough new ones to replace the fleet. The ships currently on the water are getting old, slow, and expensive to maintain. They are being pulled offline for mandatory inspections. And geopolitical tensions in the Middle East are forcing the active ones to take wildly longer, inefficient routes around Africa.
You nailed it.
It is a perfect multi-variable storm for artificially restricting the supply of available cargo space.
It is. And on the other side of the economic equation, as we discussed with China, India, and the agricultural markets, demand continues to inch upward. The total dry bulk trade supply and demand balance is expected to increase by about 1.5%.
Even with macro risks like the IMF revising global economic growth down slightly to 3.1%, the fundamental human demand for raw materials, steel, and food isn't collapsing.
Right, so you have supply structurally constrained from multiple angles, and demand holding steady or growing. That creates a massive, durable floor under the daily charter rates.
So if we look at the actionable advice here for the listener, based on all this data, if you are a current shareholder of Star Bulk.
If you are a current holder, the message from this earnings call is simple. Enjoy the 100% free cash flow dividend policy.
Yeah, no kidding.
The company is generating massive cash margins, over $12,000 a day in pure profit per ship, and management is aggressively refusing to waste your cash on overpriced new ships. Instead, they are high-grading the fleet with technology, buying back stock, and paying you directly in cash to wait out any potential market volatility.
You are literally getting paid a premium yield to hold the stock and let the macro environment do the work. And what about prospective buyers? People listening to this deep dive, looking at the data and thinking, maybe I should allocate some capital to this sector.
For prospective buyers, the data presents a highly efficient, top-tier operator with massive downside protection. Those 29 completely debt-free ships provide a $700 million scrap value safety net that few competitors have. But the actionable warning is to size your positions carefully, knowing that this is fundamentally a cyclical commodity stock. You have to watch the macro indicators like a hawk.
Right, because if the geopolitical situation suddenly changes.
Exactly. If diplomatic breakthroughs happen, tensions in the Middle East suddenly resolve, the Suez Canal fully reopens to commercial traffic, and global oil prices plummet back to $50 a barrel, the entire global shipping fleet will speed back up and take shorter direct routes.
That would immediately normalize the supply of ships, which would cause daily charter rates to drop back to earth.
Management acknowledged this explicitly. But even in that normalization scenario, Star Bulk's rock-bottom OPEX of $5,045 a day means they can remain profitable and keep paying a dividend long after their highly leveraged, inefficient competitors start bleeding cash.
Okay, so let's summarize the 3 core actionable takeaways from this massive deep dive. Number 1, the unit economics. They are operating with massive daily cash margins, driven by an incredibly low Costco-style cost structure. The fleet is running highly efficiently thanks to strategic tech upgrades like silicon paint fluid dynamics and automated hull cleaning robots.
Correct. Number 2, elite capital discipline. We're looking at a management team that has conquered the historical ego of the shipping industry.
So true.
The 100% free cash flow dividend policy, the consistent and accretive share buybacks, and the explicit refusal to overpay for new ship builds at the top of the market cycle demonstrate a rare shareholder-first level of restraint.
And number 3, The structural macro setup.
Yeah.
We have severely supply-constrained market conditions that are not going to resolve overnight.
Exactly.
A historically low global order book at 13.2%, a rapidly aging global fleet facing mandatory downtime, and geopolitical tailwinds that are forcing ships to slow down and take longer routes. All of this heavily favors the existing, efficient operators who already have steel on the water.
And we must tie it all back to the explosive operating leverage we discussed earlier. Management visualized this beautifully in their presentation.
Oh, right.
With their massive fleet of 136 ships, they have approximately 48,500 available fleet operating days per year. Because their fixed costs are so low, every single $1,500 increase in the average daily charter rate translates directly into a $71 million increase in their annual EBITDA.
Wow. And because of their 100% payout policy, that $71 million increase in cash flow translates directly into an extra 64 cents per share in the investor's dividend check. The leverage to the upside, if rates spike, is truly explosive.
It is a textbook masterclass example of how a well-managed cyclical company can generate enormous compounding value for its stakeholders, provided they maintain ruthless capital discipline and do not succumb to the temptation of empire building.
It really is. We have covered the balance sheet fortress, the daily operations and unit economics, the global weather anomalies, the geopolitical physics of the Red Sea, the underwater robots, and the radical dividend policy. It is a wildly complex, globally interconnected ecosystem, but when you break it down to the raw data, the fundamental logic of Star Bulk's business model is incredibly clear.
It all comes down to the ancient laws of supply, demand, and operational efficiency. And right now, Star Bulk has an iron grip on all three.
Well, thank you for joining us on this deep dive into the Q1 2026 earnings of Star Bulk Carriers. We've navigated the murky, volatile waters of global macroeconomics and hopefully brought some hard, actionable clarity to the structural dynamics of the maritime shipping industry.
It has been a fascinating analysis. The sheer scale of their physical operations, combined with the disciplined financial engineering required to run a fleet of this size profitably through a chaotic cycle, is truly remarkable to dissect.
But before we let you go, I want to leave you with a final provocative thought to consider.
Okay, let's hear it.
We spend a lot of time today talking about how the current global conflicts, the tensions in the Red Sea, the chaos in the Persian Gulf, are ironically helping shipping rates by constraining supply routes and forcing ships to slow steam.
Right.
Management explicitly noted that a peaceful resolution to these conflicts could temporarily hurt shipping rates by freeing up those fast routes through the Suez and speeding up the global fleet. But I want you to think about the other side of that coin.
What is the long-term implication?
Exactly. What happens to the global demand for raw materials? The millions of tons of iron ore, the metallurgical coal, the bauxite, the steel products, when the massive, inevitable wave of post-conflict global reconstruction finally begins. Think about the sheer physical volume of concrete and steel required to rebuild destroyed cities and infrastructure on a national scale across multiple regions.
That is a staggering amount of material.
Right. If you are an investor looking at the long game, looking past the immediate quarterly fluctuations of the current chaos, global peace might just be the biggest dry bulk shipping catalyst of the entire decade.
That is a very powerful, structurally bullish long-term perspective. The demand shock of synchronized global reconstruction would be unprecedented in modern maritime history.
Something to mull over as you look at your portfolio. Until next time, keep looking past the horizon.